Welcome. We're going to give people a chance to log in. Give us just a moment to get started. As our participants start to arrive, I'll begin by saying welcome and thank you for attending today. As you know, we have a habit of doing quarterly webinars, and we generally do 2 webinars each quarter. One is on the market and economic outlook, which is what we're doing today. And we'll also usually do something relating to what's happening in financial planning, tax related, whatever it might be, other topics that might be of interest to you. So stay tuned to our website, amrfinancial.com, to keep up to date on when these are happening and what's the latest. In addition, we do have a weekly radio podcast show that you may want to pay attention to as things change. There's a lot happening in the world, and we tend to keep things up to date there as well, so you can hear the latest, what's on our mind. You can find that wherever you listen to podcasts, Spotify, Apple, Amazon, whatever it might be. So hope you'll check that out. That's on the Something More with Chris Boyd podcast. And let's get started. If you have questions today, I do want to make sure you know that there will be an opportunity at the end to ask questions. But if you have questions relating to something that's being addressed, feel free to chime in with the Q&A button on your dashboard, so to speak. So that's probably the best way to let us know you have an inquiry. I also want to just in passing mention that at the end of our presentation, there will be a section for compliance details. Let's just generally remind everyone that information is obtained from sources thought to be reliable, and that opinions are subject to change. So let's get started, Brian.
All right, good morning, everybody. As usual, it's Chris and myself on the webinar today, and I know Chris will be chiming in towards the end. But let's get moving. Talk about what's going on. The first thing I want to address is a little humility. I was dead wrong in some of the comments I made last quarter regarding the change in the 10-year Treasury rate, and talk about why I was wrong, what changed in the market, and how our disciplined portfolio saved us and actually gave us a good risk-adjusted return for the last 3 months despite a rather difficult market. Then I want to talk about the bear case and the bull case going forward. I want to talk about what stage we are in the economy. I think it's very unclear, and it helps inform our asset allocation. And I want to talk about some major asset allocation changes that we're going to make, really one big one. And we're going to talk about some common questions that seem to come up routinely, especially lately. Some of these questions we've addressed in the past. Some of them are new based on the changing market dynamics. So before we get to the quotes about the Q3 webinar, I did want to throw in, a review of what's happened year to date in the markets. We can see that the domestic equity markets have done very well, 36% in the NASDAQ 100, 12% in the S&P 500. The international markets have not done as well. I would call it lackluster is the way I described it in an email this morning, at about 2%. And the bond market's been bad, negative 2% for the aggregate index. So I was dead wrong. What did I say? Well, the biggest thing that I said is I expect at worst, I expect stable rates. And the big one that I cringe when I re-listened to the webinar from last quarter, I said it would be very surprising to see the 10-year go to 5% over the next 3 to 6 months. Of course, that very surprising thing happened. So we're sitting close to 5%. We have gone over it. On any given day, we can jump over 5% right now. The one thing that I'm at least happy I didn't say is I didn't say it couldn't happen. I said it would be very surprising, and I'm here to say I'm very surprised. So what happened? The change in the 10-year. This is over the last 6 months. We've seen about a 1% rise. This, when I pulled this chart, it was the 10-year was at 4.7%. It's a little higher than that today, between 15 and 20 basis points, depending on the minute. I mean, we're seeing really incredible volatility. The higher for longer narrative from the Federal Reserve is playing in about a 30% contribution. So how did I come up with that 30% contribution and that 1% change? I looked at the 10-year, the 2-year Treasury, which more closely tracks Fed funds expectations, and that had a rise similarly of about 1%, and that similar 1% for a 2-year Treasury should contribute about 30 basis points to a 10-year Treasury yield. It's based on a time-weighted return of duration. I'm not going to get into the specifics of mathematically how that is, but it's not important. 30 basis points is a good estimate. We've seen a surge in inflation expectations. I've talked about the 5-year forward before. It's what over the next 10 years is the average expected inflation rate. We saw that jump from about 2.2 to about 2.5, give or take, 25 to 30 basis points for another 25 to 30% on the change in the Treasury rate. I really think this was war related, and both Ukraine and Russia, but also the troubles that we're having in the Middle East, where expectations of food and oil inflation has certainly gone up recently over the last 6 months. So that is a 25% contributor, and I think this is one that's harder to gauge how much. I estimated around 20%, and this was when the surge in growth in the Q3 was around 5%. Today we're looking at 5.5%. This is a real GDP estimate for the third quarter. 5.5% is exceptionally high. It's about almost 4% higher than where the Fed would like it to be. And this is getting priced into rate expectations. It's getting priced into how long you expect the Federal Reserve to be higher for, and it's also influencing inflation expectations. So this is almost like the catch-all on where you would on what it influences longer term rates. Now there's reason to believe that this is optimistic. I mean, the idea of us running at 5.5% for an extended period of time is likely fantasy. So this is one of those things that could reverse course. Now you might notice that the 20%, the 25%, and the 30% that I mentioned doesn't add up to 100%, which is true. And there's a variety of things that could make up that difference, right? One could be deficits, which we're going to talk about later. One could be quantitative tightening. One could be that the market is wrong. The market's pricing in, a fear of inflation that might not be justified, or a fear of inflation that's not being reflected in that 5-year forward. And that could be an opportunity for longer rates to come down, and that would be good for stocks. So despite being dead wrong, we actually did add a lot of value across our strategies for the last 3 months. And, how did that happen? How could I be so wrong? Well, the key is having a disciplined portfolio, right? Just because I have a thought of what's going to happen doesn't mean I put all the assets on, in the middle because, I'm holding a decent hand. We know a decent hand in any game can certainly lose. So we take a more conservative, disciplined approach. And part of that disciplined approach means targeting where the most value is going to be on the yield curve. So the red line shows the yield curve 6 months ago. The blue line shows the yield curve more recently. And we could see that there was a lot of opportunity on the front end of the curve. Basically, you can take very minimal risk and expect a decent return. Why step too far away from that? And we didn't. We were heavily towards the front end of the curve there. And how did we do it? Well, there's an ETF in everybody's portfolio. It's the biggest position, biggest fixed income position in almost everybody's portfolio. And that is a JP Morgan Ultra Short ETF, and that the ticker is JPST. And what JPST is, it's very similar to a money market fund, except it can take a little bit more risk. It has a little bit more volatility, but I also expect it over a longer term to outperform cash. What's the benefit of this? You can see that we're getting a higher yield at almost 5.4% since when I pulled this slide. And it's only taking about 10% of the interest rate risk as the aggregate duration. So we're getting, like I mentioned, less risk, more yield. That's a win, right? So that's where despite being dead wrong, we had a disciplined portfolio. We looked at this kind of situation and we said, this is where we want to be. And that's helped our client portfolios. In addition, for mostly valuation reasons, we have been underweight equity across strategies. So you can see there on the 30-70, about 27% equity, the 50-50, about 45% equity, 60-40 core explorer, 56, 65-35, 61, and the 85-15, 79. So as we've had a bit of a sell-off here in the market over the last 3 months, we were helped out by being a little bit underweight. So what's the bear story? I'm going to talk about some data points that I've run into that leave room to be bearish, and then I'm going to talk about some bullet points about what gives me reason to be bullish. But I want to emphasize that even as I go through the next few slides, and they look a little ugly, the thing I am most concerned about, and by far, is the surging 10-year yield. That is the number one thing that makes me bearish. So the next few bullet points, I'm not going to rehash the 10-year yield because we just talked about it. But these are some additional things to keep an eye on that I don't want to lose sight on. They might not necessarily be in the headlines. So one thing that we're seeing is this is delinquency 90 plus days for auto loans by people's ages. Credit, I didn't put the credit card slide in here because the chart looks very similar. I don't think it really gives you much more additional information, but what we're seeing is younger borrowers are delinquent in a way that we haven't seen since really the financial crisis. Older borrowers are doing just fine. This is a dichotomy that is interesting and can skew, more aggregate measures of debt service rates. We know that with the personal savings rate jumped $2.1 trillion during the pandemic for the 3 years with all the excessive transfers that we had from the government. And at the same time, those excess savings have been drawn down 1.9 trillion. And this was from the San Francisco Fed just a couple months ago. So this excess savings that we've had that's driven retail sales, that's driven employment, it's almost totally spent. So what we need to hope for is that the labor market continues to be strong, where real wages continue to be positive, to continue to drive this economy going forward. At the same time, we're seeing tighter credit standards. So this is standards for small firms, annual sales of less than $50 million. This is the bulk of the economy, small businesses. And what we're seeing is that banks are becoming considerably tighter. They've double the respondents have said from previous surveys have said that they are tightened considerably, but the big numbers are tightened somewhat, and what we had seen a change to 44.1%. This is a big leap, and even a small change in this could be problematic. And why is it problematic? Because of this slide. We're seeing speculative grade companies need to refinance their debt in a more significant way in 2024 and 2025, 2026, 2027. That's that yellow bar there. You can see that really hasn't been an issue in 2023. And let's ignore the blue bars for now because investment grade non-financials are probably going to be fine. But these smaller companies are going to find it harder, to get credit, which is what we saw on the prior slide. So that could lead to more bankruptcies. And the ones that can get credit are going to see significantly higher rates, significantly higher fees, and it's going to lead to significantly higher problems and lower profit margins. This is going to happen. Now, the question is whether the economy is going to be strong enough where sales are going to grow faster than the interest rates are going to pick up. And from what we've seen, at least in the third quarter, that's definitely a possibility that the economy could grow at a pace that could make up these interest rate changes. The flip side of that is, rates might not stay as high as they are now forever. I mean, we have seen inflation come down. We are seeing real rates being significantly higher than they have definitely in the decade between the 2010s and the 2020s. So that would also, give a break to the speculative grade companies that need to refinance their debt over the term. But under the basic scenario that we would all expect, under normal sales growth, under a normal economy of 1% to 2% growth, this would be a very significant problem that we all need to keep an eye And one of the ways that you can tell if this is an issue is if you're seeing increased bankruptcies, increased defaults, these types of things that just they haven't happened yet. And I think this is what, one of the things that we need to think about when the Federal Reserve says long and variable lags to interest rate policy. These people don't need to refinance their debt for 2025. They still get a couple of years of runway. So that's the tough thing, right? We're seeing credit standards getting worse. We're seeing younger borrowers seem to be having a little bit more trouble. We're seeing, those are some big issues, credit issues. The 10-year Treasury continues to rise, right? Not giving any break to those credit issues. But there's also a pretty convincing bull market out there, bull argument out there. And I actually think the bull market might be a little bit stronger, all things considered, if we can get some stability in the 10-year rate. So the big thing that we're seeing is that forward earnings are expected to be exceptional. We're talking about 12% growth in 2024 and 12% growth again in 2025. The long-term average growth in earnings per share is about 9%. And there's huge volatility that leads you to that 9%, but 12% is a significant reach from over that 9%. So, this is very bullish. This is the expectations. And typically we say, earnings expectations are optimistic and they're going to come down. Well, what that red squiggly line that says 24 towards the top right shows, we've already had that. It's already come down. So, there's a lot of optimism and a lot of reason to believe that this 240 number that we're expecting in 2024 could come to fruition. So we also still have a very strong employment picture, right? And this is the best possible case. We're seeing the U.S. labor force go up. We're seeing the prime age workers between 25 and 54 continue to rise. This is what we call a Goldilocks employment picture. Hopefully this sustains, right? This is the virtuous cycle that we all want. My spending is your income and vice versa, and that can continue to push earnings higher. The problem is when we're at an unemployment rate at 3.8%, you need to continue to have a growing labor force to continue to have growth. And you could just see the wall coming a lot easier and a lot quicker than you can if, unemployment is at 7 or 8%, for example. So things are still very good in the employment picture. And hopefully they can remain that way as they have for much longer than a lot of people thought they would. So under normal scenarios, you would expect there to be positive wage growth, right? So the purple line here is wages and salaries in the US. The orange line is the CPI. And typically, wages and salaries grow faster than CPI. That is as you can see from 2014 through 2022, that has been the case, right? Then that flipped in 2022, which was a real problem. And we were helped by the government transfers, right? Where people had some excess savings to hold them through, which is why we didn't have a recession caused by inflation. Now that situation has reversed itself, which is very good. Wages are above inflation. This should help profit margins. This should help make people feel a little bit better, which is good for consumer spending going forward. Overall household debt service is historically very healthy. So we talked about how younger borrowers, particularly in credit and autos, are having problems. Well, homeowners aren't having any problems. Most people have a fixed rate mortgage below 4%. That is a very reasonable, debt service level for people to cover. Now, in addition to that, older borrowers are doing exceptionally well. So when you look at these things in aggregate, younger borrowers are having a bit of a problem, but they're employed, right? That's what we saw from that prime age workers. And older borrowers and homeowners are doing exceptionally well. And we know that mortgages are a very large part of the credit picture in the economy. So, to sum all that up, people have jobs, earnings are expected to do great. There are part cracks in the credit market that we've seen, that we can foresee or that we are seeing, especially in younger borrowers. But in the aggregate, the picture looks pretty good. So the bullish scenario is pretty convincing, and the bearish scenario gives you some reason to pause. Now, what stage are we in? This is a huge debate, right? People go, is it going to be a soft landing? Is it going to be a hard landing? when you look at the data, I think it's very unclear where we are. I think we could be in the mid-cycle, late cycle, or we could be entering a recession soon. So, this chart's from Fidelity. I think they do an excellent job, laying this stuff out. They think we're in a late cycle of the economy. The late cycle typically has moderating growth, moderating earnings, or even contracting earnings. And small caps typically are starting to fall off the edge, but not quite into the recession. You want to have an emphasis on quality. Tech typically isn't doing as well, but in reality, what are we seeing? Right, we're seeing the Russell 2000 has already had nearly a 30% drawdown. This is already pricing in a recession. It already has priced in a recession, and it started in January of 2022. So if you look at this, you would say, okay, we've already had a recession in the small cap market. So what we should expect is some kind of recovery at some point, right? That could happen. But going back to that bear market scenario, I could also foresee a recession in 2 years, a year or 2 years, as those credit maturity walls come to fruition. So you can make an argument there. Now, at the same time, we talked about how earnings rates are growing at 12%. Earnings aren't moderating. We talked about growth being at 5.5%. Growth isn't moderating. That's a mid-cycle scenario, right? So we could be in the mid-cycle, we could be in the late cycle, we're probably in the late cycle. And some assets have already reflected recessionary type headwinds, as the recession was highly expected by lots of market participants that never came. So this is showing that we're even seeing expected growth in small caps. So, in 2023, the earnings in the S&P 600 was, around $86. And going forward, it's expected to be, 10% higher, closer to $93. That's not moderating growth. That's accelerating growth. That would expect, we've already seen the asset prices fall in the small caps, and we're seeing accelerating growth. You would expect us to be coming out of some kind of recession. So it's interesting that small caps are pricing like we're in a recession and acting like we're moving into a recovery. Large caps are acting like we're in a mid-cycle. And the debt markets are telling us that, we're probably in the late cycle and a recession is a year and a half away. There's a lot of question marks here. So we need to consider that when we're making asset allocation decisions. So, what are we going to do? How does this all come together? What kind of changes are we making? Well, we talked about in the fixed income section how we're very concentrated on that short part of the curve, and it still makes sense to do that. It's making less sense to do that as time goes on, and we're seeing the longer end of the curve come up. But until there's a term premium there, I think it's still prudent to hug that front end of the curve. So JPST is going to continue to be a very big part of your fixed income portfolio. We're going to continue to be underweight stock for all those reasons where we could be in that late cycle stage, right? If we're in that late cycle stage and the market starts pricing large caps for recession in a similar way that they've already priced small caps, well, I don't want to be overweight stock. But what if the earnings expectations of 12% come to fruition, which there's a good argument that they will, especially in 2024, possibly in 2025. Well, then I definitely want to make sure I'm in that allocation in the stock. I don't want to be too underweight. So how do we marry all that, right? How do we do all those risks? Well, what we're going to do is continue to be underweight stock, but we're going to add an alternative position, which is called a defined investment. So what's a defined investment? Well, it's really an option strategy where I'm going to participate in the upside to a cap, right? In this scenario, it's typically about 15%, where I'm going to, if the market goes up 15%, I'm going to participate in that. Now, on the downside, there's a buffer. If the market were to fall 15%, I wouldn't lose anything. And I think this is a good marriage of this bull and bear scenario. We want to take advantage of the upside, but buffer the downside. This isn't going to be a huge part of people's asset allocation, somewhere between 4 and 5% of the portfolio. But I think it'll help us continue to deliver some risk-adjusted returns. Now, what's the downside of this, right? Well, I have to fund this somehow, right? So I could keep it in JPST, where I'm fairly certain that over the next 3 months, I'll be able to generate another 1% return. Well, if this doesn't go anywhere, I get 0% return. And that's a trade-off. The second trade-off is this makes me want to trade it more, right? Because if I buy a November defined investment and it goes up by 5%, well, now I'm plus 5%, but I can also lose 5%. I don't hit the buffer until I hit that 0% again. So it makes me want to trade out, take that 5%, and get the next buffer in the next month, where I can start at 0 again. So it increases trading. It could increase capital gains. I, as usual, will always be sensitive to capital gains. I will not take it if I can't, but that is a possible downside to this kind of asset.
Just one quick caveat to point out on that. There is downside buffer, but it is not unlimited. So, if there's a drastic decline, eventually we'll also get participation in that from this position, but it'll be less so.
Yeah, if there's a drastic decline, you're going to participate in some losses. If there's a drastic upside, you're not going to get all the gain. And that's a trade-off as well. So we're going to continue to have a very high quality portfolio. I took a 50-50 portfolio that we would have in our design today. And I just said, hey, look, what are the stocks underlying all these ETFs and mutual funds we have? Well, you can see their household names. The top few names are Apple, Microsoft, Amazon, and NVIDIA, Google, Tesla, Meta, ASMLF, LVMH, Visa. We're not taking, outsized crazy risks. We're not, getting into an IPO venture market or anything like that. We're going to continue to stay high quality, particularly when, I think the market's priced fairly, and I think there are significant risks and a variety of opinions on where we are in the market stage. So we're going to talk about some common questions here. We've had a couple of discussions about annuities, the pros and cons of them. I think there's most of the cons. The deficit, geopolitics, student loan payments, and artificial intelligence. I talked about this on the radio last week with Jeff Perry to some degree, and or maybe it was 2 weeks ago. So I'm going to try to go over it in a relatively due time, but I'm happy to continue to talk about this if there's more questions on it.
Yeah, and these are in part the result of questions that came into us in preparation for the seminar, so the webinar. So thank you for those who submitted questions.
So what is an annuity? An annuity is you give a premium to an insurance company. They invest that money basically on your behalf. They take a fee and they pay you back that money, and they call it a guaranteed income stream. What you can do is just recreate that yourself without paying commissions or surrender charges. What is a surrender charge? Well, if you want the money back before the company is ready to pay it to you, you have to pay a significant charge. And why is that? Because they invested in this portfolio, and there's a liquidity cost, especially if interest rates have gone up, and they need to make up the difference for that. Now, you could take an unrealized loss. Instead of taking a surrender charge, it'll probably have a tax benefit, and it'll probably be significantly less than the surrender charge. Now, in addition to that, I want to point out, look at the rates on these bonds that we're showing. I just pulled this randomly from Schwab one day. They're probably in the range of whatever annuity is being quoted.
And just for clarity, we're talking about fixed deferred annuities in this scenario. There's a whole range of different kinds, but just continues.
Right. So typically, I think this is great for the insurance company. It's great for the person who sold it to you because they're going to get a commission. There's a little risk to the insurance company because they're going to put in surrender charges, and you're going to get an income stream, that's probably just a little bit worse than what you would get otherwise. So, it seems like it's good for everybody, and it's just okay for the consumer. I think I'd rather recreate it myself, even if I was extremely risk averse.
So just as a follow-up to that, if you need help with this or something you're thinking about, you want very low risk, you're looking at alternatives, what would you look at? Talk to us about that. There are bond portfolios using CDs and treasuries and high credit quality corporate bonds that we can structure to help you do that, if that's helpful.
So federal deficits, this slide is from JP Morgan Guide to the Markets. They have it in there every single quarter, every single month, whenever they update it. This is very good for giving you a snapshot of what the federal deficit and the federal debt looks like. And it's true, it's high. The federal deficit is, it's lower than wartime levels, but it's not far off. It's certainly, higher than it has been, particularly in the 2010s to the 2020 decade, where even though it was on a steepening trajectory, it was between 2 and 4% of GDP. Now we're looking at somewhere between 5 and 7% of GDP. To give you an idea, during COVID, we were at 15% of GDP. So it's certainly higher. What does this mean? Well, you do need to issue more debt to make up the difference. If you're at 2% GDP and you go to 4% GDP, well, you have to issue more debt to make up that difference, twice as much. In addition to this, I want to bring up quantitative tightening. Quantitative tightening has been an interesting thing that I have made a significant effort to try to learn more about. So there is a big correlation between quantitative tightening on bank balance sheets and the S&P 500. And I've been trying to understand this correlation for a long time, and how what it should do is really impact interest rates, which it will impact the stock market. So what are we seeing? Well, quantitative tightening, basically a bond matures, Treasury pays the Federal Reserve. The Federal Reserve essentially retires that cash. We've talked about money printing. This is basically money burning. They retire that cash, and the Treasury doesn't get an inflow from the Fed in terms of income, which they were getting prior, and they're not, and they have to recreate that cash somehow through borrowing. So that's what they do. They go out to the market and they have to borrow more money, and this can be anywhere on the curve, right? So where quantitative tightening, in logical sense, should only affect the front end, if the Treasury has to go out and issue more on the longer end, well, there could just be more supply to buy on the longer end, which could cause in the short term rates to tick higher. So this is, these are two of the reasons why I think that could make up that 25% difference that I can't account for between growth, inflation, and changes in Fed policy. This is something to consider. So, one of the questions we got is, how do I think about this in terms of asset allocation? Well, federal spending, even any government spending, even in municipality level, should be stimulative and inflationary. So it's been stimulative. I mean, we haven't had a recession. We're seeing growth, 5.5% in Q3. It's been inflationary. We all saw during COVID that inflation rates went higher. And now there's this tug of war, right, between interest rates and federal spending policy. So the more the government spends, the more I would expect interest rates to rise, and the more I would want to allocate to the front end of the curve. And I think from an asset allocation perspective, that's a very simple way of thinking about it. Now, if interest rates continue to soar, I'm also going to be more inclined to continue to be underweight equity, which we have been.
Before you change that slide, I think one of the common questions we get is, where's the tipping point? How much can we have for debt? When does it become a drag on the economy? Can you just give a quick comment on any aspect of those common questions?
My answer always has been, I don't know, but I actually do know a little bit, right? Because we had a test case during COVID. We know that we spent too much based on the supply that was in the economy. And how do I know that? Because inflation soared. So, the tipping point would be a devaluation of the dollar, inflation soaring, the government not being able to control interest rates. It just doesn't seem like there's any evidence that we're there yet. We saw the tipping point a couple of years ago, but that seems to have reversed itself. So, it's hard. I mean, this is an age-old question. It's probably not good. We probably can't spend forever, but I don't think anybody truly knows what.
Yeah, I think that's fair. But I do think that this is perhaps why this is becoming a more frequent talking point, in politics as a cause for concern. People are recognizing that, we're getting a little bit ahead of ourselves, and we have an issue that could be a problem in the making if we don't deal with it sooner. The likelihood of it being addressed quickly and successfully is probably going to take a long time, and it's going to be challenging. But in any case, not a problem today is the sense you're sharing.
That is the opinion. I think, again, I think this could be having an effect on the longer term treasury rate. I think it could be a deterrent premium. So I'm not saying it's not
without its
applicable,
consequences.
not without merit. But I'm not saying that it wasn't an issue 2 years ago. I think it certainly was. But I think this is some kind of catastrophic problem that we need to spend a ton of time on? No. What I do think is that if we continue to spend money this way, I'm going to continue to hug the front end of the curve, and we're going to continue, to be careful about going overweight equity again if longer term rates continue to soar.
Thank you.
So, we obviously get questions about geopolitics constantly. Jeff Perry is very good at talking about it. I think it's his favorite subject. It was kind of funny on the radio. I mentioned, Jeff, I have these 5 things I want to talk about. Geopolitics might have been number 4. And he goes, okay, so you want to talk about geopolitics? And that was the number 1 thing he wanted to talk about. It's just kind of funny. And sure, I mean, hey, look, there's a lot of reasons to talk about geopolitics. First of all, it's just interesting, but second of all, it does have some kind of control on your money on a macro level. Do I think it's the biggest thing? No, I don't think it's the biggest thing. But let's talk about what I do think is important. The Israel conflict is obviously bad for oil and gas, right? It's a bedrock for oil and gas supply throughout the region. We saw during the 7-Day War in 1973 that there was an oil embargo, and that obviously caused significant problems. We saw during the Ukraine-Russia invasion there was a problem with fertilizer and grain coming out of the Black Sea. That certainly had an influence on particularly headline inflation. And I would expect that to continue. But on the grander scheme, I think is more interesting to talk about, and probably has more longer term consequences for your money and for your asset allocation. And that is this kind of triangular type of geopolitical network that we're seeing. Post World War II, there was the First World and the Second World, right? There was communist nations, there was capitalist nations, and they often warred with each other, right? Between Korea and Vietnam, there wasn't a lot of trading. Following that era was kind of a more globalization effort, right? China got entered into the World Trade Organization. The Iron Curtain fell in communist Russia, and they were trading grain, they were trading oil. Now we're seeing a bit of a barrier come up there. We don't talk about this often, but a lot of the tariffs from the Trump administration are still in place under the Biden administration with China. But there is this third block as well, which trades with everybody. They kind of stay independent, and it's led by India. And India is a fast-growing economy with over 1 billion people. And we should definitely acknowledge that their influence now is much more than it was during that first or second era. So during that first era, we saw soaring interest rates. We saw inflation problems as countries warred together, and there was inflation, particularly driven by oil in that first period, but also government spending. In that second period, we saw interest rates drop to rock bottom, even zero or negative real interest rates. And in this third era, where we're still trading with China, even more and more every year, right? Even though there's this conflict. And we have this third block that's important, that's trading with everybody. We still have some globalization, maybe a retreat from the rapid expansion of globalization that we had before. And now we're seeing real rates again, right? So right now, real rates on the 10-year are around 250 basis points, or 2.5%, which is high compared to what an economist would tell you should be the case for an economy like the United States. And it's very high compared to what we saw between 2010 and 2020. And the trajectory is obviously up, as it was in the post-World War II era, and the opposite of it as it was between 1980 and 2019. So
Just
You know,
to clarify for people who may not know the lingo, real rate refers to the rate less the inflation.
right. So it's interesting dynamic that, and this is one of the reasons why I would expect to see real rates for longer, where we didn't necessarily see that in the prior regime that we all remember. That wasn't too long ago. Student loan payments. So about 20% of Americans have student loan payments, and the average student loan payment is about $340. They started again in October, so people will be getting their first, and interest started in September. So people will be getting, if they haven't already, gotten their first student loan bill. This is, a good amount of money to take away from the average person, $340 a month. And it could be much more for some people and much less for other people. And I think this is going to continue to snowball that issue that we saw in delinquencies, for example, in younger folks, for example. So, this is something that we are paying attention to. This is not at all reflected in the retail sales numbers that we've seen recently, which have been, quite frankly, off the charts, which is part of the reason why we're seeing, 5.5% growth in Q3. So this is something to monitor. I think a lot of us college educated people tend to think that everybody is college educated and everybody has student loan payments. That's not the case. 80% of the country does not have student loan payments. So it might be in your mind a greater issue than it is in reality, but it's no doubt a very big issue for a certain cohort of the country.
As you transition slides, I just want to mention to everybody, if you have questions, now's a good time to add your questions to the Q&A box or the chat area. Either one is fine, so that as we approach the end of our program, we'll be able to address any additional questions.
What is artificial intelligence? Well, artificial intelligence so far is defined as large language models is the way I think about it. It's the most significant change that we've had, and that's most obviously exhibited by the emergence of ChatGPT, even though there's many other applications. I think it's not a fad. This is here to stay, and it's going to have implications that are so wide-ranging I can't fathom them. Interestingly, we saw Microsoft, which owns a very large stake in OpenAI, and Google both report earnings yesterday. Google's cloud service, it grew, but Microsoft grew significantly more. It took share. I think this is reflective of the fact that they are implementing their artificial intelligence IP into the cloud network. Google hasn't necessarily had the same execution as Microsoft has in this space. Not to say they won't in the future, but I think this is a good example of how this continues to propel the markets forward. The quote unquote Magnificent Seven this year have had a lot of exposure to artificial intelligence, and to me, I think this has been a big driver, and especially a large driver of the NASDAQ, but it's been a big driver of the overall domestic US market growth that we've seen over the last 12 months. So, what are the takeaways? The rapid sell-off in 10-year Treasury, it's been surprising and it's been negative. Higher growth, tighter Fed, increased inflation expectations. These are the things that explain the bulk of the change. I think quantitative tightening, I think deficits that could certainly play a part on the margins. There are cracks in the debt markets. We talked about those younger borrowers. There's continued liquidity tightening. Regional banks are not lending to commercial real estate. You think about it that way. Increased earnings expectations, strong employment, and real earnings lead to some optimism, right? The cracks that we're seeing, they could be solved by growth. Growth covers up a lot of problems. We're likely in the late cycle, but this is very unclear. I mean, I see evidence of us being in the mid cycle. I see evidence of us being, where assets are being priced as if it's a recessionary environment, or at least they were anticipating a recessionary environment. One of the things that I often get asked is why aren't we more rules based, right? If Fidelity says we're in late cycle, why aren't we just positioned like we're in the late cycle? Well, the assets aren't priced like we're in the late cycle. The assets are priced like we're in a recession. And what comes after a recession? A recovery. So, the prices don't necessarily align with the expectations of market participants. we're going to have a continued cautious approach. We've been underweight stock, we've been short duration. We're going to continue to do those things, but we're going to add this defined outcome position so we can participate in market upside while continuing to try to limit any downside that we might see, particularly from the surging 10-year Treasury rate. So disclosure page, leave this up if anybody has any questions.
So now's a good time if people have questions. We did have some questions submitted. Brian tried to incorporate some of the content to speak to some of those issues. One of the questions that came in was more directly tailored toward political considerations. And, we tend to talk about this in election years, Brian, but, whether party control in one party makes a difference or not, and how it affects things. I think, one of the things that this time of year, as we kind of move toward an election cycle, it's more prevalent in people's mindset. We've had the spectacle of the change in the Speaker of the House and the difficulty and the dysfunction in trying to have the legislative body work well together. How much is this something that you think is directly problematic for markets? I think you already addressed this to some extent, but worth restating some of these issues that, what's the direct connection, or to what extent is there a direct connection with how I should think about my portfolio and what's happening in Washington, D.C.?
Well, I think in part of the question that we got was, it was kind of saying the Biden administration has been so terrible. It was basically announcing their political stance right up front. What are we going to do about this? And so one of the things I did was I just looked up since election day in 2020, how's the market done? And the S&P 500 was plus 34%. So the stock market hasn't done bad during the Joe Biden administration. The bond market has done poorly. That's true. I mean, this is, I don't think we've seen things like this in the long-term Treasury market since the Civil War. That's interesting. It's interesting, but I think what I do is I put it in the context of the economic environment we're in more than the political environment we're in, because the economic environment is typically more telling than the president. People tend to think that the government has more control than they do. And a good example of this would be if you just look at the biggest companies in the S&P 500, for example. Let's just take Apple and Microsoft. They're going to have more influence over the returns of the S&P 500 than the president. Tim Cook is the CEO of Apple. I would take his earnings call as more evidence of how the S&P 500 is going to do going forward than any State of the Union speech, for example. Satya Nadella has done a fantastic job at Microsoft, and Microsoft has given returns for that reason. Look at what NVIDIA is doing. NVIDIA, I don't think anybody knew what NVIDIA was or did, 5 years ago. And now I think a lot of people have at least some kind of semblance of, or at least what they've heard of the stock, right? That none of that stuff has anything to do with the government. And I think one of the value adds that we have is taking a more sober approach to what the government's doing and how it might impact your investments, by acknowledging, for example, that deficit spending can be inflationary and stimulative, but also recognizing, the extent to how much that can influence the markets.
And there is understandable concern about, whether or not we'll have a government shutdown, if we can't get this speaker problem resolved, and people worry about these kind of things, and that very well may have some.
Sure. Well, let's talk about the government shutdown, right? The workers tend to get their back pay, and it tends not to last that long. So it can be scary, it can be for interesting headlines, but the reality is it has had very minimal impact on the
long-term economic consequence and therefore market.
Since they've been doing it since the Reagan administration, it's just not that significant.
So try not to get too anxious about your portfolio in the context of that scenario. It's likely very short term.
Sure, the debt
And
is going to come up again, and that always gets solved at the 11th hour. The consequences are too dire, and I think everybody understands that. And it's mostly gamesmanship.
I think you talked about this pretty effectively on the question of world events. But this came up yesterday, and I think people who pay attention to the news, many of our clientele are very attuned to what's going on in the world, and whether it's Russia's invasion of Ukraine and what's the consequences of that, and the ongoing problems and the need for whether we're going to fund some support for that, or now Hamas attacking Israel, and you start to envision this runaway escalation of what could be warring throughout the Middle East and Persia, Iran kind of thing, and then that brings in world powers, and suddenly we're in World War III. These kind of concerns are things to be aware of and mindful of, but let's not run away with it just yet. It's not today's worry. In that, hopefully cooler heads will prevail. Diplomacy will bring things to a little bit of a slow the pace of this anxiety. And I would just say don't necessarily alter your portfolio because of these concerns at present, until we there's something to be watched, not something to be acted upon today. So in any case, those are a couple of quick things. Looks like we don't have any other questions, Brian. So thanks for all your comments. Any parting thoughts?
No, other than the fact that let's not lose sight that it's been a very good 12 months for the stock market and for most people's portfolios. And I always say that we should be investing for the long term. We should have our eyes at least on a 3-year marker. But I understand that it's easy to get caught up in the last couple months, the last quarter. But let's take that longer term perspective. That'd be my message as always.
Yeah, and I think your underlying theme was essentially cautious optimism. That there's reasons to be paying attention to what could go wrong, but perhaps there's compelling case to at least have some sense of things may be going well, and that there's things to look forward to in a favorable way. So we've taken some steps to be mindful of this. As you know, we do our trading in the discretionary portfolios, usually around the time of the activity of this presentation. So you will likely be seeing some trading activity. If you have any questions about your portfolio or other issues that may be happening in the world and you'd like to talk about that, don't hesitate to reach out to us. We're available. You can reach us through our website, amrfinancial.com, or you can give us a call, 508-771-8900, toll free 866-771-8901. Please feel free to share our comments with friends and family if it's helpful to them. Okay, thanks, Brian.
Thank you, guys.